Hi students, so in this certificate in corporate finance program, now we are going to discuss the accounting concepts and principles. So in the previous class we had a discussion about the meaning of accounting. In that we discussed that accounting is a information system which identifies the data, collects the data, processes the data and provides the final information to its users. So after this particular meaning of accounting, we will be having a discussion on accounting principles and the concepts which are to be followed by the accountants and the accounting bodies throughout the world. So the major objective of this particular accounting concepts or principles is to bring the uniformity and reliability for the users. See, generally why we need accounting? Generally we need this particular accounting to provide the required information to its users. Users may be the managers, they may be the employers, they may be the government bodies, they may be the creditors, they may be the debtors. So they want to know the performance of a business entity or nothing but they want to know the performance of a company. So that's why they will be depending upon the accounting for the purpose of measuring the performance of a company. So for this, to solving this basic objective of this particular users, all the accounting bodies and all the accountants throughout the world or all the companies need to follow the basic rules and the regulations, and we can say these particular regulations as principles. So now we will be having a cleared we will be having a detailed discussion about the basic accounting concepts and the principal concepts are nothing but the principles. So if you see the basic concepts of accounting, generally the very important basic and very important concepts are business entity concept, money measurement concept, going concern concept, and dual aspect concept, accrual concept, matching concept, and historical cost concept, realization concept, and conservatism concept, prudence concept. So these are some of the basic concepts of accounting. Now we'll discuss in detail. If you see the first concept, that is business entity concept. If you see the first concept of accounting, that is business entity concept. So this particular business entity concept can also be known as entity concept. This particular business entity concept can also be known as entity concept. So now what this particular business entity concept says? The business entity concept says that whenever you are preparing the accounts, you need to prepare the accounts from the business point of view. You need to prepare the accounts from the business point of view, and you need to remember that owner and the business both are different. Business entity concept says that owner of the business and the business both are different, and whenever you are preparing the accounts, you need to prepare the accounts from the business point of view. Suppose example, Mr. X invest 1 lakh rupee in a restaurant. Example, Mr. X invest 1 lakh rupee in a restaurant. Now we will be preparing the accounts from the restaurant point of view. You will be preparing the accounts from the restaurant point of view. So why? Because business entity concept says that the person who invests in a business and the business both are different, and whenever you are investing the amount or whenever you are preparing the accounts, you need to prepare the accounts from the business entity or nothing but you need to prepare the accounts from the entity point of view or nothing but business point of view. So in this case, Mr. X invests 1 lakh rupee in a restaurant. Now if you apply this particular business entity concept, X is different, restaurant is different, amount is coming into the restaurant and amount is going from the X. So you will be preparing the accounts from the restaurant point of view, and you say that, and you will be showing that 1 lakh rupee invested by X into the restaurant, that 1 lakh rupee you will be considered as a cash inflow. Business entity, according to business entity concept, the 1 lakh which is invested by Mr. X in a restaurant should be considered as a capital or a investment, and it should be considered as a cash inflow from the restaurant point of view. So you should not record the accounting transactions, or you should not prepare the accounts from the owner point of view. Always you need to prepare the accounts from the business point of view. So this is about the business entity concept. Once again I will brief about this business entity concept. Business entity concept is a concept which says that owner and the business both are different, and whenever you are preparing the accounts, you need to prepare the accounts from the business point of view. This is about the business entity concept. And if you see the next concept, that is going concern concept. Next concept is going concern concept. So this is also a very important concept in the accounting concept, that is going concern concept. So going concern concept says that whenever you are writing the books of accounts of a particular company, whenever you are writing the books of accounts of a particular business, you need to assume that that particular business or that particular company will be continued for a prolonged period. You need to assume that that particular business or that particular company will be continued for a prolonged period in future. Suppose we'll have a small example with this. Suppose example, Mr. Ram gave 50,000 rupees as a loan to X company. Mr. Ram gave 50,000 rupees as a loan to X company. So when Mr. Ram is giving that particular 50,000 rupees to the company, he will assume that the company will continue for a prolonged period. If he give the amount of 50,000 rupees, and he will be receiving that particular amount for a after particular period of time, and he will be getting a interest. So that's why the amount which is given by Mr. Ram to the X company is considered as a creditor from the company point of view. So whenever you are recording the books of accounts, you need to assume that the company or a business will be continued for a prolonged period. So this is about the going concern concept. Going concern concept is a concept which says that whenever you are preparing the books of accounts of a company, you need to assume that that company or that particular business will be continued for a prolonged period in future. So if you see the next concept, that is money measurement concept. Next concept is money measurement concept. So this particular money measurement concept says that you need to record only those transactions which can be measured in terms of money. Money measurement concept says that always you need to show only those transactions in your books of accounts which can be measured in terms of money. We'll try to understand this particular concept with an example. Suppose accountant in a particular company is a very knowledgeable person, or something we can have like this also. Mr. Kiran is an accountant of Wipro company, and Mr. Kiran is a very nice person and a very skillful person. Suppose this is this is a sentence. Mr. Kiran is an accountant in a Wipro company, and he is a very nice and a very skillful person. Can we record this particular case in the books of accounts? No. Why? Because the skill or his quality cannot be measured in terms of money. So this particular case or this particular statement cannot be recorded in your books of accounts. Why? Because money measurement concept says that we need to record only those transactions which can be measured in terms of money. Now we'll discuss in other way. Same Kiran who is working as an accountant in a company, or nothing but who is working as an accountant in a Wipro company, gets an annual salary of 5 lakhs. Gets an annual salary of 5 lakhs. Mr. Kiran is an accountant in a Wipro company. He gets an annual salary of 5 lakhs. So this particular 5 lakhs can be recorded in the books of accounts from the company perspective. Why? Because this is a statement which can be measured. The salary can be measured in terms of money. We are saying that his annual salary is 5 lakhs. So that's why this statement can be recorded in the books of account, because this is something which can be recorded in terms of money. So I will brief about this particular money measurement concept. So money measurement concept says that we need to record only those transactions which can be measured in terms of money. Quantitative and the transactions which can be measured in terms of money should only be recorded in the books of accounts. Qualitative transactions should be ignored when you are preparing the books of accounts. So this is about the money measurement concept. And if you see the next concept, that is dual aspect concept. Next concept is dual aspect concept. This is very important concept in accounting. So dual aspect concept says that every transaction in a business, every transaction in a company will be having two effects. Every transaction in a company will be having two effects. Now we'll try to discuss with an example. Suppose X company purchased machinery of rupees 1 lakh. X company purchased machinery of rupees 1 lakh. This is a business transaction. X company purchased machinery of rupees 1 lakh. This is a business transaction. Now this particular dual aspect concept says that this particular business transaction will be having two effects on your accounts. It will be having two effects on your accounts. So we'll see in what way it will affect. Okay, first thing is X company purchased a machinery. X company purchased a machinery. So a machinery is coming into the business. Your company will be having a new machinery. That is one effect. Machinery of rupees 1 lakh. Machinery is coming into the business. Nothing but your company will be having a new machine of rupees 1 lakh. This is one effect. The machinery value in your company will be increased. Suppose example, already you are having two machines. Now you purchase another machine. Now your total number of machines will be 3. That is one effect. And the next effect is, suppose let us assume that before this transaction your company is having 10 lakhs cash. Let us assume that before this transaction your company is having 10 lakhs cash. In that cash your company utilized 1 lakh for purchasing a machinery. Now definitely there will be your cash balance will be from 10 lakhs 1 lakh is utilized. Now the balance will be 9 lakhs. Balance will be 9 lakhs. So let us assume that already your company is having two machines. Let us assume that worth of machine is 5 lakhs. Before this transaction your company is having two machines. The worth of machine is 5 lakhs and the company is having 10 lakhs cash. After this transaction your machines is increased to 3. Your machines is increased to 3 and your value of machines also increased to 6 lakhs. Right? And before this transaction already said that your cash balance of the company is 10 lakhs. Out of 10 lakhs 1 lakh is utilized for purchasing the machinery. Now your total available cash balance is only 9 lakhs. So if you observe this, purchase of machine of rupees 1 lakh had two effects. One effect is increase in the machine value, other effect is decrease in the cash value. Increase in the machine value is one effect and decrease in the cash value is another effect. So this is the concept. This is nothing but the dual aspect concept. So it says that every business transaction will be having two effects. So this is dual aspect concept. So after this dual aspect concept, next we will be discussing about cost concept. After this dual aspect concept, next we will be discussing about cost concept. So this is the cost concept. So cost concept can also be known as historical cost concept. Cost concept can also be known as historical cost concept. So this particular cost concept or historical cost concept says that whenever you are recording the value of an asset in your books of accounts, it should be recorded at its acquisition price. Whenever you are recording the value of an asset in your books of accounts, it should be recorded at its acquisition price. Now, acquisition price means the cost which is incurred by you for purchasing an asset and the cost which is incurred by you for bringing that asset to your office or a factory. Cost concept says that asset should be recorded at its acquisition price in your books of accounts. Acquisition price means the cost which is incurred by you for purchasing an asset and the cost which is incurred by you for getting the asset to your office or factory premises. That is nothing but the acquisition cost. So always the asset value should be recorded at its acquisition cost in your books of accounts. So this is about the cost concept or historical cost concept. So next, after this cost concept or historical cost concept, we will be discussing another important concept, that is accrual concept. Another important concept, that is accrual concept. Now this is very important. What this accrual concept says. So generally, whenever you are recording the transaction, you will be following two methods. One is, you will be following the two systems. One is cash system, and the next one is mercantile system, and this mercantile system can also be known as accrual concept. Whenever you are recording or whenever you are preparing the books of accounts, you will be using two systems. One is cash system and the other one is mercantile or nothing but accrual system. Cash system is very simple. Cash system says that whenever you are recording an expense or whenever you are recording a revenue, it should be recorded only when there is a cash inflow or a cash outflow. It says that whenever you are recording an expense or whenever you are recording a revenue, it should be recorded only when there is a cash inflow or cash outflow. Suppose example, today you purchased a computer for rupees 1 lakh. So simply you will be recording computer and rupees you will be writing 1 lakh. Today you paid a bank loan of 10 lakhs. So bank loan 10 lakhs. So cash system major objective is transaction should be recorded when there is any inflow or outflow of cash. This is about the cash system. But if you consider the fairness of the financial statements, cash system may not be showing the effective results. Cash system may not be showing the effective system. Why this particular cash system may not show the effective system is, generally if you observe the modern business, 75% of the transactions is through credit basis. Generally companies, in order to increase their turnover or in order to increase their sales, what the companies will be doing, they will be purchasing, they will be selling the goods on credit basis, and in the same way they will be purchasing the raw material also on the credit basis only. 70 to 80% of the business transactions in the modern business is only through credit basis. So this particular cash system may not be showing the effective results for this modern business. So that's why we will be following an important reliable concept, that is nothing but accrual concept. So what this accrual concept says that all the expenses and the incomes should be recorded as and they arised. all the expenses and the incomes should be recorded as and they arise. We'll try to discuss with an example. Suppose in January, in the month of January, we purchased 5 lakhs raw material. In the month of January, we purchased 5 lakhs raw material, and we had an agreement with that particular seller that we will be paying this particular 5 lakhs after 3 months. In the month of January, we purchased raw material of 5 lakhs, but we make an agreement with the seller that we will be paying this particular 5 lakhs after 3 months. So after 3 months means we will be paying in February, March, April. We will be paying in the month of April. We purchased it on January, but we will be paying the amount on February. We will be paying the amount of 5 lakhs in the month of, sorry, not February, April. If you follow the cash concept, you will be recording this particular 5 lakhs in the month of April. If you follow the cash concept, this particular purchase of 5 lakhs of raw material, you will be recording in the month of April. But according to accrual system, you will be recording this particular transaction in the month of January itself. You will be recording in the month of January itself. Actually, in this case, we purchased the material, but we didn't pay it. We will be paying the amount after 3 months. After 3 months, but we will be recording this particular purchase transaction in the month of January only. Why? Because accrual concept says that all the expenses and all the revenues should be recorded as and they arised. The purchase of this particular 5 lakhs is arised in the month of January. So accrual concept says that this particular amount should be recorded in the month of January itself. This is about the accrual concept, and this is very important concept in your accounting. Maximum all the companies will be following this particular accrual concept only. So once again I will brief about this particular accounting concept, accrual concept. Accrual concept can also be known as nothing but accrual concept is something which is derived from the mercantile concept. It says that all the expenses and the incomes should be recorded as and they arised. Cash inflow, cash outflow is secondary, but in case of cash system, all the expenses and the incomes will be recorded only when there is any cash inflow or cash outflow. So this is about your accrual concept. This is accrual concept. After this particular accrual concept, we will be discussing the next concept, that is matching concept. So this matching concept is also very important. So depending upon this particular matching concept, you will be preparing your financial statements, especially profit and loss account. So matching concept says that all the expenses and all the revenue should be matched with each other. All the expenses and the revenue should be matched with each other. This is about the matching concept. We will try to discuss with that. So matching concept says that all the expenses and the revenue should be matched with each other. Now we will try to understand this matching concept with an example. Suppose example, let us assume that this is a profit and loss account. This is a profit and loss account of a X company. So in this what we wrote, simply your total income, nothing but we can write like this, total sales value is 10 lakhs. Total income or nothing but the total value, sales value is 10 lakhs. So there is a revenue of 10 lakhs of that particular X company of that particular financial year. For getting this particular 10 lakhs, you will be having the several contributions. Suppose example, for getting the sales, first you should have the raw materials. To sell a product, first you should manufacture it. For manufacturing the raw material, for manufacturing the finished product, you need a raw material. So to get the sale of 10 lakhs, definitely there is a contribution of raw material also, and you are saying that contribution of raw material as purchases. So for example, 1 lakh. In that particular year, you got a total sales is 10 lakhs. But for getting this particular 10 lakh sales value, first we consider the contribution made by the raw material. So total contribution made by the raw material is nothing but the purchases. So the purchase value is 1 lakh. Okay, we purchase the raw material also. That particular raw material you purchase, and you need to get the raw material to your factory premises. So nothing but we can write it as transportation expenses. Let us assume that it is 1000 rupees. Transportation expenses, that is 1000 rupees. For processing this material, raw material, for converting the raw material into your finished product, you need labor or you need the employees, and you are paying to them salaries. For getting the salaries, for getting the sales of 10 lakh, definitely there will be a contribution of labor also, and you are paying a amount to the labor as a compensation. Let us assume that this is 5 lakhs. Right? And for this you need a building. For that building also you are paying rent. Let us assume that this is another 2 lakhs. And you will be incurring other expenses also for this. Let us assume that other expenses is 9,000. And definitely there will be a contribution of machinery also for selling, for manufacturing a product, and for that contribution you are showing it as depreciation. Depreciation on machine, let us assume that this is 20,000. So out of 10 lakhs, to get the sales of 10 lakhs, these are the contributions. For getting the sales of 10 lakhs, there will be a contribution from raw material, and you are paying compensation as purchases and showing it as a purchases. And there is a transportation expenses, that is transportation expenses, salaries, contribution made by the employees, nothing but salaries, rent, other expenses, and the contribution made by the machine, that is nothing but depreciation. So what we did, we followed simply matching concept. How we follow matching concept? Revenue and the expenses. Revenue and the expenses should be matched with each other. Now in this case, if you find, definitely we will be finding a difference. That is 1 lakh 1,000, 6 lakhs 1,000, 7 lakhs 1,000, 7 lakhs 10,000, and 9 lakhs. So you will be finding a difference of 1 lakh, and this is 1 lakh goes to the contribution. This 1 lakh is something which is applicable to the contribution made by the owner of the company. So that's why we are saying it as profit. So what we did, we matched the expenses with revenue. To get the revenue of 10 lakh, these are the contribution which is made by the different factors. So matching concept says that all the expenses should be matched with all the revenue. The contribution made by the raw material we paid as a compensation as purchases, contribution made for transportation expenses, contribution made by the labor and we are saying it as salary, contribution made by the building that we are saying as rent, other expenses, and the contribution made by the depreciation, nothing but machinery, that is nothing but depreciation, and the contribution made by the owner, that is nothing but profit. So matching concept will be majorly applicable in this profit and loss account. All the expenses and the incomes both are matched. This is about this matching concept. And if you see the next concept, so after matching concept we will be discussing another important concept, that is realization concept. This is something completely contrast to the concept cost concept. This particular realization concept completely contrasts to the cost concept. In cost concept we said that all the assets should be recorded at its acquisition cost in the books of accounts. But realization concept says that some assets should be recorded at its market value in the books of accounts. Some assets should be recorded at its market value in the books of accounts. Let us assume that you purchased a land in 2001 You purchased a land in 2001 for rupees 1 lakh. Now since 2001, if you show same 1 lakh as a land value in the balance sheet, definitely it won't be considered as a fair practice to show the financial statements, because definitely the value of that particular land in this particular 2016 will be high. So relation concept says that some assets should be recorded at its market value So next important concept is concept of conservatism. Concept of conservatism can also be known as prudence concept. So this conservatism concept says that whenever you are recording the books of accounts, you need to consider all those future losses which you may face in future. Conservatism or prudence concept says that whenever you are preparing the books of accounts, you need to consider all those losses or expenses which you may face in future. So due to this conservatism concept only, we will be considering the bad debts. Suppose example, you are recording the books, you are preparing the profit and loss account or the balance sheet, right? So you need to get around 10 lakhs rupees from your debtors. Your company should get 10 lakhs rupees from your debtors. But from the last 5 years, you had observed that every year there is a chance of 5% in as bad debts. From the last 5 years, you observed that there is a chance of 5% as bad debts. Bad debts is nothing but the amount which you cannot recover from your debtors is known as bad debts. The amount which you cannot recover from your debtor. Debtor is nothing but the person who owes to us, the person who need to give amount to us. So the amount which we cannot recover from your debtor is nothing but bad debts. So from the last 5 years, you observed that every year there is a percentage of 5 or nothing but every year 5% of chances are there for bad debts. This year also you need to get around 10 lakhs rupees from your debtors. When you are preparing the books of account, what you will be doing? Out of 10 lakhs, you will be considering 5%, that is nothing but 50,000 rupees, and you will be showing this 50,000 rupees as a debit side, as bad debts or nothing but as a provision for bad debts in the debit side of your profit and loss account. Actually, you don't know. You may get or you may not get. But this is something which is related to future. But if you observe the past history of your company, you got a conclusion that every year there is a chance of 5% for the bad debts. So what you did this year, your total debtor value is 10 lakhs, and after 10 lakhs you calculated the 5% and it comes to 50,000, and you showed this particular 50,000 rupees as a provision for bad debts in the debit side of your profit and loss account, and in your balance sheet also you showed only 9,50,000 as your debtors. That particular 50,000 you may get or you may not get. So, but why we consider in this year itself? Because consistency concept says that whenever you are recording the books of accounts or whenever you are preparing the books of accounts, if you feel that there is any chance of loss in future, that particular loss should be recognized now itself. This is about the concept of conservatism or prudence. And the next concept, that is consistency concept. Next concept is consistency concept. So consistency concept says that already in the beginning of this particular class, I said that account is something which is used by the users. So account should be reliable, it should be fair enough. So to bring the uniformity of this particular accounting, all these concepts should be followed consistently. Whenever you are applying the different accounting concept, that particular concept should be applied, or that particular concept should be consistently applied for preparing the books of accounts. So this is about the consistency concept. And if you see the next concept and the last concept, that is accounting period concept. So going concept says that whenever you are recording the books of accounts, you need to assume that the company will be continued for a prolonged period. So this accounting period concept says that Accounting information should be segregated into different periods. This accounting period concept says that accounting information should be segregated into different periods for the purpose of comparison. Suppose example, in our schooling up to 5th class primary school, 6th to 10th class high school, we won't be writing all the 10 classes in a single year. We will be writing every exam in this particular academic year only. And every academic year also we will be having different examinations, one quarterly, half yearly, pre-final, finals. Why we are having the different examination pattern? Because it is very useful for comparing our performance with history and the future. So in accounting also, all the accounting information should be segregated into different accounting period for the purpose of comparing the financial results of the entities. So in this accounting concept, or nothing but this accounting period concept says that accounting information should be segregated. It may be by following the financial year. Financial year is something which starts with April and ends with March of next year, or a company may follow the academic year, nothing but calendar year, which starts with January and ends with 31st December. So accounting period concept says that accounting information should be segregated into different periods for the purpose of comparing the financial results. So these are nothing but the basic accounting concepts and the principles which are to be followed by the accountants and the accounting bodies for the purpose of providing reliability and bringing the uniformity in this accounting.